My high-yield ETF dividend investing strategy is about a year old. Today I'm going to give you an update on the status of the experiment and how I got to where I am now. I'm trying to turn $1,000 of interest-free margin that Robinhood Gold provided me into $1,000 of my forever fund, SPYI. At the end of this video, I'll go into the details about my strategy. But first, we'll take a look at the current status of the account. Despite the sell-off in the market on Friday, my account value actually went up about 0.75% this week, up to $2,245. So where does that put my margin maintenance ratio? I'm at 10.58% above the threshold, so I have a $236 cushion. Let's head over to the margin screen. As I mentioned earlier, I have a $1,000 interest-free margin loan through Robinhood Gold, and that's what I'm using for this experiment. My margin status is low risk. I have a little bit of buying power available. If we scroll down and take a look at the maintenance ratios for my positions, they're all unchanged. 25% for everything except for 35% for NVII. This is important if you have a larger account, but for me, the $2,000 margin minimum is the main number I have to keep in mind. So how did I end up with these particular ETFs? Most of them are not the ones that I started off with. So let's take a look at the history of the account. Here's a look at the overall timeline of 2025 and 2026 for the account. Let's walk through this together. In early July of 2025, I purchased my foundation fund, which is the PGIM AAA CLO ETF. In order to enable margin, I needed at least $2,000 of my own contributions into the account, and that came from PAAA. From mid-July till the end of July of 2025, I purchased my 4 ultra-high-yield ETFs that were the foundation of the experiment. I no longer invest in any of these ETFs, but I'll quickly show you what they are. NVII is a Granite Shares Yield Boost ETF based on NVIDIA, but it doesn't simply sell options on NVIDIA shares. The underlying asset is a 2 times leveraged or 200% NVIDIA daily ETF, and the current distribution rate is about 47%. Next, I bought CHPY from Roundhill, part of their weekly pay ETF lineup. It's also leveraged, but only about 120%, and it's aiming for a calendar week total return. It's currently paying about 74%. Then I purchased SPYI, which has been a wildly popular ETF, currently distributing about 85-86%. My last fund was also from YieldMax, SNOY, paying a similar about 83% distribution rate. As soon as I had purchased all of my shares in late July, I ran into trouble in early August. Due to share price declines, I dropped below my margin minimums and was faced with a margin call. To rectify the problem, I transferred 2 shares of PAAA into this account. That was worth about $102, and that brought me out of the danger of a margin call. By November 5th of 2025, it was time for me to make my first portfolio change, and the first ETF on the chopping block was MSTY. Here's a look at the price return chart for MSTY, the underlying stock MSTR, and the S&P 500, just for comparison. And this represents the time period when I purchased MSTY on July 23rd until I sold it on November 5th. As you can see, the price return was terrible, down 51%, compared to MSTR, it's down 38%. The S&P 500 was up about 7%. So I lost half of the value of my MSTY shares. Let's take a look at total return. It's still ugly. Did a little better than MSTR when you factor in the dividends, but still down dramatically. I had to make a change. I used the proceeds of my sale of MSTY to buy HOOW, another of the Roundhill weekly pay ETFs, with 1.2 times margin. The distribution rate was considerably lower than MSTY, but I felt like I needed to make a change. Only a couple of weeks later, in late November of 2025, I was in margin trouble yet again. So once again, I transferred 2 shares of PAAA worth about $102 into the account to resolve that margin issue. And by late January 2026, I was ready to move on from CHPY. In this chart, we've gone back to price return. From the date I purchased my CHPY shares in July to when I sold them in January of 2026, the ETF was down 73%. The underlying was down about 51%, while the S&P 500 was up about 10.5%. These are brutal results. Let's take a look at total return. Not much better, with CHPY still down over 59%. So I sold it and used the proceeds to buy BLOX, which is crypto related, but this fund is a lot more diversified, and it pays out about 36% annualized on a weekly basis. It was only about a week later that I decided HOOW and SNOY both had to go. Let me show you why. Back to price return, and here's a similar story. From the time I bought it in November till the time I sold it in February, it lost 64% of its value compared to its underlying that had lost 49%, while the S&P 500 was essentially flat. Take a look at the total return, and still down almost 57.5%. Remember, this is on top of the MSTY position that I sold down about 50% to purchase HOOW. So this sleeve of my income investing was devastated. And since COIW was also down so much, I decided to combine the positions. I used the HOOW proceeds to buy more BLOX. So I went from 4 ultra high yield ETFs down to 3. I held on to SNOY from July 29th of 2025 to February 5th of 2026. By the time I got rid of it, it was down over 48% compared to the underlying down about 28%. S&P 500 was up almost 7%. Going to total returns, it was about even with its underlying, both down around 29%. So not as bad as some of the other funds I had. Although I had been burned by 2 yield max funds, I decided to use the proceeds of SNOY to buy CHPY. It provided considerable diversification into a hot sector. Distribution rate of this fund is around 40%. In late March of 2026, margin trouble reared its head again. This time I transferred 1 share of PAAA into the account. It was worth about $51. So in total, I've transferred 5 additional shares worth about $250 to add as buffer to my account to keep me above the margin minimum of $2,000. And by late April of 2026, I decided to move on from NVII, the NVIDIA fund investing in a 2x leveraged ETF. Like my other ultra high yield ETFs, the problem with NVII was the price return, the NAV erosion. This chart represents price return from when I purchased it in July of 2025 to when I sold it in April of 2026. I held on to this one longer than any of the other funds. But as you can see, the price return was down almost 46.5%, while the underlying was up over 17%. The S&P 500 was up over 13% during this time period. So it lost about half the value of the ETF when looking at price return alone. So what about total return? It's actually in the positive at 10%, but it's still trailing the underlying and the S&P 500. I decided to stay with an NVIDIA-themed ETF, but I moved over to REX, an NVII. This ETF still pays out a hefty 40 or 45% distribution rate, but it's not leveraged and has had a better history. If you want to learn more about the ETFs I've swapped in and out of and why I did it, I have dedicated videos for each of those transactions with information like this on how the funds compare and their history. And now you're caught up on all the major milestones. Throughout the entire history of this experiment, I've been purchasing shares of SPYI, my forever fund. I'll get into the details of my strategy at the end of the video. Now I want to show you one more thing about my account. This is the Robinhood Legends screen showing all of my individual account holdings. They're currently sorted by market value. So PAAA is at the top. SPYI has worked its way all the way to second, followed by CHPY, NVII, and BLOX. At the very bottom, I have several cryptocurrencies, but all these together are only about $10. These were rewards that I received from various Robinhood promotional giveaways. Unfortunately, when I got them, they go into this account. So the account value here, the $2,245, does include these cryptocurrency holdings, which are not part of the experiment. It's simply a complication that I have to live with. Before we move on to dividends, I wanted to quickly review the share price return for my portfolio this week. PAAA is not included because it's just pretty steady. Everything took a turn for the worse at the end of the week, but several of the funds remained positive. So overall, not bad. Now let's catch up on dividends. NVII paid me about 21 cents per share for a total of $1.61 this week. I split the dividend in half. 81 cents is awaiting next week's dividend so that I'll have enough to reinvest into NVII. The other 80 cents went to SPYI. So far, my combined NVYY and NVII positions have paid me $183.65 in dividends. And this current dividend is about a 41% annualized rate of return. BLOX paid me almost an identical dividend to last week, a little under 10 cents per share, and it came in 1 cent under last week's dividend. I was able to combine this 45 cents with some previous weeks to reinvest back into BLOX. This sleeve started out as MSTY, then became HOOW, and when I sold HOOW, I combined it with the proceeds from the sale of COIW, and they all went to BLOX. And all of those ETFs combined have paid me $164.50 so far in this experiment. BLOX pays out 36% annualized rate of return. CHPY paid me a little under 55 cents per share for $1.65. The dividend in red you see is awaiting reinvestment. And so far, the combination of SNOY and CHPY have paid me a little under $114. If we go and take a look at PAAA, we can see that I've earned almost $111. Those dividends get reinvested right back into PAAA, and I don't really count them towards the experiment. I also received my SPYI dividend of 53 cents, almost exactly the same as the last week. But because I continued to reinvest weekly, even though they're very small amounts, the dividend went up at an all-time high of $2.50. It hasn't been reinvested yet. I just got it on Friday, and it'll automatically reinvest first thing Monday morning. So here's the return summary. It gives you a better idea of where things stand. The NVII and now NVII position is down about 24%. The combination of the MISTI, HOOW, COIW, and now BLOX position is down almost 74%. The SNOY and CHPY combination is down about 15%. So for my ultra high yield ETFs, overall, I've lost almost 47%. That's offset by my SPYI gains. Everything I've invested into SPYI is from the dividends of these high yield ETFs and SPYI's own dividends. So when you combine the losses here with the gains here, overall we're down about 22% 1 year into this experiment, which I have to admit is disappointing. I'm happy that the SPYI position is growing, but I would have hoped that the total return would have been higher for the high yield ETFs. And at the beginning of this experiment, I wouldn't have guessed that I would have had to have bailed on all 4 of my original high yield ETFs. I think one of the major lessons here is the importance of price return. A lot of times we can focus on total return, but if a fund is paying out too much in distribution that it can't keep its price up, it's a sinking ship. 100% distribution is great, but if the share price keeps going down, even if they keep the distribution rate the same, the amount you're getting every week or every month is decreasing. So I've tried to find a middle ground, ETFs that have a really high rate of return, but not so high that they can't maintain their share price, and hopefully I can avoid NAV erosion. For those of you who've stuck it out this far and want to learn a little more about my strategy, I'll briefly go over it, but you can check out the first 5 videos in the series for a comprehensive breakdown. I invested $2,000 of my own money into PAAA. It doesn't pay a ton, about 4.5%, but it's better than most high-yield savings account, and it serves as my margin foundation. Because I'm a Robinhood Gold member, I get a free $1,000 margin loan. I do pay for that gold membership, but I was doing that anyway. It's a little more than $4 a month, and this interest-free loan is one of the perks. So I took out a $1,000 margin loan, split it into 4 groups of $250, and invested in my original ETFs, COIW, NVIY, MSTY, and SNOY. And as we've discussed, I've changed those investments, going from 4 to 3 high-yield ETFs. I split the dividend I receive each week from those investments. Half gets reinvested back into the fund, and the other half goes into my forever fund, which I chose as SPYI. It's NAV stable, and it's something that I hope I can keep for years or decades. I built that position up to about $250. Once it gets to $1,000, I'll use all of my dividends to pay down the margin loan. Once it gets down to zero, I would have accumulated $1,000 of SPYI at no cost. At the rate I'm going, it's going to take another couple of years. But if you find this video series or this experiment interesting or helpful, I'd really appreciate it if you would like and subscribe for future updates. I have some ranking videos on Roundhill ETFs and the holdings within CHPY that may be of interest to you also. Let me know what you think of the experiment now that we're 1 year in it. And remember, nothing I said here today is financial, investing, tax, legal, or any other kind of advice. I'm just inviting you along my journey. Good luck hunting those infinite dividends. Take care.